Master the 20, 50, and the 200 exponential moving average on TradingView. Boost your trading game. Hey everyone, welcome back to our channel. Today we are diving into one of the most powerful tools in technical analysis, exponential moving averages, or AS. Specifically, we will be looking at the 20, 50, and the 200 moving averages. So we will explain what they mean, how to use them, and why they are so important in trading. So let's get started. So first, let's break down what EMAs actually are. So as you can see in the chart here, we have three different lines over here. We have a blue one, green one, and a yellow one. The blue one is the exponential moving average 20. I mean the 20 exponential moving average. And then we have the green is the 50 exponential moving average. We have the 200 exponential moving average. So as I said, let's break down what EMA actually are. EMA are a type of moving average that places more weight on recent price. Because as you can see over here in the chart, in the x-axis, we have the volume, and in the y-axis, we have the prices. And this chart is composed by candles, various candles. Each of them has an opening price, closing price, and the higher price and the lower price. So the EMA are a type of moving average that place more weight on a recent price data, so making them more responsive to price changes. Then I may say simple moving average. So on TradingView, you can easily add the 20, 50, and 200 exponential moving average. Going to the tab here, the indicators, and then look at EMA. So you can add them easily. I'm not gonna show you that over here because I add them already on the chart. So what they do, they help you to identify trends and make a informed decision about your trading journeys. So let's start with the 20 exponential moving average, the blue one over here, up here. So this is your short-term trend indicator. Why? Because it reacts quickly to price changes. It make it perfect for identifying recent market momentum. So when the price, let's zoom this one here so we can see it easily. As you can see, when the price is above the 20 moving average, the blue line, it typically indicates a short-term uptrend. You see this one here. All the prices that are above the 20 exponential moving average, it indicates a short-term uptrend. Conversely, when the price is below the blue line, it suggests a short-term downtrend. So on TradingView, you will see how this line, the 20 exponential moving average line, hugs the price closely, offering insight into immediate market direction. It following the price closely. Next up is the 50 exponential moving average. the green one that we have over here. So this one represents the medium trend, This EMA provides a broader perspective compared to the previous one. I mean, to the 20 exponential moving average. It's slower to react to the price, but helps confirm the direction of a trend. When the price stays above the 50 moving average, let's move it here. When the price stays above the 50 EMA, it signals a medium term uptrend. As you can see over here, it's above the EMA, the 50 EMA. So we are in an uptrend. So this is signal a medium-term uptrend, as I said. And when it's below, we see a downtrend, as you can see this one here is below this exponential moving average, the 50 EMA. So this one here is a downtrend. So traders often look at the 50 EMA for confirmation or trend strength, or to spot potential reversal. So now, finally, let's move to the 200 moving average. This one here, the yellow one. The yellow one is the 200 EMA. So the 200 EMA is your long-term trend indicator. And this one is one of the most important moving averages in technical analysis, the 200 one. When the price is above the 200 EMA, in this case over here, as you can see, and let me remind you that we are in a 1 hour time frame, okay? So here we have the price is above the 200 EMA. Clearly is this one here. Let's this one here, all these are above the 200 EMA. Okay, so what does mean? It suggests a long-term uptrend. So as you can see, this chart here is the NVIDIA stack. This is the NVIDIA stack. And the price closed at 123 and 74 cent. $123.74 on Thursday, 22nd, 2024. Okay? So we still in an uptrend. So as I said, when this happens, it suggests a long-term uptrend indicating bullish market. We are still in a bullish market. Yesterday price closed under 130, and this morning when the market opened, the price opened above 130, but the price went down later on. I mean, when the price is above the 200 exponential moving average, it suggests a long-term uptrend, indicating a bullish market sentiment. When it's below, it signals a long-term downtrend. Let's see if there is the case here. Look this one here. All this area over here, when we were in a downtrend, the price were below the 200 moving average, and we start going bullish on Tuesday, August 13, 2024. Okay, so now we are in a bullish market over here. We're still in a bullish market. As long we are above this 200 exponential moving average, we still in a bullish market. Okay, and this price here gonna be like 108, something like that. When we arrive to 108, so we're gonna be now in a bearish market, you know. So the 200 exponential moving average often acts as a dynamic support and resistance. This is very important. This is what make these indicators one of the most important, because the 200 EMA often acts as a dynamic support and resistance. And traders pay close attention to how the price behaves around this line, because, you know, institutional investors, I mean, smart money, big banks, large institution, billionaire, they love to trade on supply and demand. And when we are talking about the resistance is like the supply is different, is a little bit different, but it's so similar. Supply and resistance, the support is like the demand. Okay. So now let's talk about the crossover. We have defined the different, the three EMA that we have here, the 20, 50, and the 200. We have given their significance and the meaning. Now, let's talk about the crossover. Crossover occur when one EMA cross above or below another, right? They are all moving. Sometime, for example, in this case over here, on this case over here, they cross over. And they also cross over here. See? So when one EMA cross above or below another, signaling potential changes in market direction. That's what it does. For example, when the 20 EMA here, this one here, the 20 EMA is the blue one over here on this, let's mark this one here. The 20 EMA cross above the 50 EMA, what does mean? It's often seen as a bullish signal. And we can see it here clearly. We are in a bullish signal. It was in a bullish signal over here. Okay? So we can use this as an entry point, you know, for medium term or short term. So suggesting that the market may continue to rise. Conversely, when the 20 moving average cross below, it's a bearish signal, indicating potential downside of the market. So crossover involving the 200 EMA, the crossover indicating the 200 EMA, one of the most important indicators, are especially significant, as we can see on this area over here. So this often indicates a major shift in the market sentiment. And that's what happened here. Let's remove this line here, remove this one here. So you can see over here, the blue line, I mean, the 20 EMA cross the 200 EMA. And here, the 50 EMA cross the 200 EMA. Reason why this one indicate a major shift in market sentiment. And look what happened here. What happened then was, look at this bullish. market here that we have seen in the market after that happened. Okay, so this is very important. So now let's remove this here, and finally let's discuss now trend strength. We can see over here, let me remove this so we can clean up this. So now here you can see that there is a space between the 20, 50, and 200. I mean, there is a gap between them over here. So the space in between the 20, 50, and the 200 EMA can give you insights into the strength of a trend. When these exponential moving averages are widely spaced and moving in the same direction as you can see here, as we can observe here, this indicates a strong trend. This indicates a strong trend. Conversely, when the EMA are close together, it may signal consolidation. Let's move this. Let's see this in a 5-minute chart, okay? And look at this one here. Look at this one here. Look at this one here. They are moving closely to each other. All these things. This is consolidation, okay? When they are moving closely together, it may signal consolidation or weakening trend. But this one here is a 5-minute chart, okay? Let's go back to the 1 hour time frame, okay? And this is a long term. So now, in conclusion, I would say that the 20, 50, and the 200 exponential moving average are powerful tools that can help you make a smarter trading decision if you understand them. Most of traders use these indicators. So whether you are identifying trends, I mean spotting crossover, or looking for support and resistance using the 200 exponential moving average, these EMA are essential to that. So remember, I'm not a financial advisor. This is just my assessment based on my research. If you find this video helpful, make sure to like, subscribe, and hit the bell icon for more trading tips. Share your thoughts, please, in the comment below. How do you use EMA in your trading? Thanks for watching, and see you in the next video.